weak environment is good enough, it's a sell.
Thanks, Sudarshan, for those ideas. Markets look flat for opening. Let's see what the policy brings for us. Vetri Subramaniam of Religare has joined in now, for Religare Invesco Mutual Fund, actually. Vetri, good morning. Thanks for joining in. Before we talk about the market, how significant is the event today, the RBI policy, and do you think that moves the market's needle a lot?
I'm sure there'll be a bit of excitement around the policy, Udayan, but I think the consensus has also moved to the fact that they're not really expecting any action, and it is, I think, pretty much likely that the RBI will stay on hold, to the extent that they perhaps signal that the recent weakening in WPI and also a little bit of ease down in CPI, though it still remains quite high, starts to open up a little bit of headroom for them, perhaps going forward. That may help the market a bit. But then again, you've got to factor in the issue that, with the currency depreciation that we've seen in recent weeks, there's going to be a lot more inflationary pressure come through the system. So I don't think, the RBI policy in that sense may actually end up delivering a surprise. And I think, keep in mind the last few weeks of volatility have actually been driven more by the US Federal Reserve and their comments on quantitative easing. And we have that meeting as well scheduled, I think, for tomorrow or day after. So, that might prove to be much more of a global market moving event than the RBI policy itself.
Here comes the opening bell. We'll get back to this discussion. 15 points up on the Nifty now at 58.22. Stable opening to trade, but nothing significant. 65 points up on the Sensex. The market seems quite relaxed ahead of the RBI policy. No great nervousness is visible as of now. Now up 7 or 8 points, so flattening out some more. M&M does get a good response to its deal, 1.5% up on that one. Infosys post comments from Narayan Murthy is up 1% to 24.20. There is a little bit of strength in autos like Maruti and Hero Motorcorp. Dr. Reddy's is not doing too badly. Hindalco from Metals, Sesago as well, and Ambuja Cement have opened up in the green, but the gains are very modest. So even stocks like Reliance, Coal India, DLF and BHEL have put on about 0.5%. Only two stocks in the Nifty up more than 1%. That's Infosys and M&M. So it's not like a rip-roaring start to trade. On the losing side, IndusInd Bank loses a percentage point. ITC is quite subdued at about 328. JSPL continues to lose more ground after all the damage it's seen. NTPC is down. Tata Motors not great after the mild JLR disappointment. And some of the private banks like Kotak and ICICI Bank have also eased out a little bit, which is why the Nifty is now up just 3 points. It is a flat start to monetary policy day, at least for the large cap universe. How about the mid caps, Mithali?
On balance, it's a bit disappointing actually, Udayan. I mean, even the stocks that are holding up are not exactly best of breed from the broader market space. But two of those Mahindra stocks that we were talking about have had a sharp reaction, positive reaction today. So Mahindra Eugene is up 10%, Mahindra Forgings is up about 8%. Some of the gains are getting tempered, though I might add. Educom, that had a disastrous week gone by, opens in the green. So that's up 2.5%. And there's a little bit of buying on infrastructure. Faces like Lanco, Adani Power, Syntex was doing okay, but it's a thin list really of gainers. On the losing side, actually, there's quite a few sharp reactions. Jet Airways, primary amongst them, in reaction to the deferral again by FIPB. That stock has opened down almost 11%, and the volumes are building up on that. UCO Bank from the banking space is down about 2.5%. Some of these forex issue companies continue to bleed. Opto Circuits is a case in point. That stock is down about 2.5%, and there is some weakness as well on Titan that managed to pull back a little bit towards the end of the week. Titan opens this morning down about 1.5% in trade. So it's really a pretty poor mid-cap start, I would say. In fact, as we speak, the mid-cap index that had opened in the green has now slipped into the red. The market breadth is very tight. It's about 400 to 300 roughly, that kind of gap, and that could close in very soon. And the frontliners as well seem to be slipping into the red. So the market's got an undercurrent of nervousness. You can see that today on the screen again.
Yeah, I think it's probably preparing for a no rate cut scenario in an hour's time or a couple of hours' time. You can see that in the banks and the rate sensitive. So all your UCO banks and Indus, many of these bank names have started coming off. It would be instructive to see what the bond yield is doing. That has hardened over the last few weeks, ever since the rupee became so volatile. So that probably is also pricing in something not very encouraging from the Reserve Bank. But that's where we start, flat, with not great market breadth, and waiting to see what the central bank has to say later in the day. Vetri Subramaniam is with us. Let's get right back to him. How are you feeling about the market now, Vetri? Has the rupee soured your near-term view on the market? Has it made it more difficult for the macros?
Not really, Udayan, because I think if you think about it, at the end of the day, I think the weakening of the rupee that we are seeing first is driven a little bit more by global events, and the way most emerging market currencies have reacted is very similar. Secondly, even you've seen current account surplus economies actually face pressures on their currency. So in a sense, the pressures are more global. But I also think in that sense, if you look at the issue that we have on the trade account deficit, while there are many structural issues that need to get addressed to make Indian manufacturers more competitive, clearly one of the ways in which you can reduce some of your imports, or at least consumers do respond to price changes, and therefore one way to do that is that the falling rupee incentivizes some of your exporters, makes them more competitive, and at the same time will possibly lead to a little bit of import substitution in the domestic market. So in that sense, I think the weak currency is really part of the readjustment process that we need to go through. And the only thing is that it needs to be orderly. We don't need any panic in the market. We've got a huge dependence on foreign capital inflows to fund that deficit. And I think so far the RBI and the government have, sensibly sort of stayed to the sidelines and, just sort of assuaged the market rather than trying to do anything dramatic. So I don't think the rupee fall in that sense has really kind of, perturbed us or caused us to panic. I think, one of the issues that we've always worried about has been the debt overload that a lot of Indian companies are carrying, and in some cases a lot of this is dollar denominated debt, and they don't necessarily have a hedge on their P&L in terms of their dollar denominated revenue. So that's something that we've always worried about, and those fears are starting to get even more real given the fall that we've seen in the rupee. But I think in terms of strategy, it's not really changed our views too much, and in a sense this is part of the adjustment process that we need to see for this economy to eventually stabilize.
Vetri, hi, good morning. Does it further delay this big earnings recovery expectation, though, both on account of the fact that things don't seem to have picked up that much on the capex cycle over here, and that many of these individual accidents will probably get reported in the next quarter that you were just alluding to?
Actually, on the earnings, it's a bit more tricky if you just try running the numbers through an Excel sheet, and that's not necessarily how they will pan out in the real world as the numbers come out over the next quarter or two. What the numbers tell you on an Excel sheet is that actually there is a fair degree of positive effect which comes through on earnings because of the fall in the rupee. Remember, we've got a large contribution of profits now coming from export-driven companies in the IT arena, in the pharmaceuticals arena, and even a lot of traditional Indian service-oriented businesses like, for example, telecom or, for example, automobiles, simple manufacturing businesses now have a large portion of their revenues coming from global operating units. So the actual impact on their earnings may actually tend to be positive. And even as far as commodity companies are concerned, in most cases, they tend to price in dollar-denominated prices. So while, some international commodities have been weak, these companies will benefit if they are able to take benefit of the fall in the rupee. So actually from an earnings perspective, it's not so clear that there will be a negative impact. In fact, a back of the envelope or an Excel calculation suggests that the impact might actually be marginally positive. But yes, I mean, it's very stark when you start to look at gainers versus losers, because where there are some companies which will benefit on the P&L account, there are a lot of companies that are going to face severe stress on account of debt. So really in that sense, I don't want to generalize it. I think you'll need to look at this on a company specific basis. But as far as earnings are concerned, it may actually be net positive, the fall in the rupee, rather than being negative.
If you were to sit back and gauge the situation as of now versus when we were talking, say, 2 months back, though, Vetri, would you say things have actually turned for the worse? I mean, for the currency in whatever shape and form, for what's happened with crude, growth doesn't seem to be picking up at the pace people expected, neither on the consumer side nor on the industrial side. How are you feeling about the way things have turned out?
Yeah, 2 points over there. First, again, as far as the currency is concerned, it's not something that perturbs us. I think this is part of the readjustment. But I think the more sort of worrying issue is that, while we've seen a lot of traction and the government has tried to push through a lot of issues on the policy front, they've tried to clean up some of the issues on the investment cycle. I don't think that has really got as much traction as one would have wanted. I think, some of the stuff which has happened in the last 6-7 months, since August, literally since Chidambaram took over in the finance ministry again. Some of it has been great, whether it is, freeing up oil prices, starting to move petrol prices in line with market, removing the subsidy, reducing the subsidy on LPG, trying to reduce the deficit on diesel. So some of this has been fantastic, and 12 months ago, I don't think the market ever expected these decisions would be taken. But as far as the investment cycle is concerned, it's still a little of one step forward, one step back. We've seen some progress on the DISCOM restructuring, but it's not yet complete. GST nowhere near implementation, and I think with the developments in Bihar, now you can presume GST is pretty much pushed out till well after the general elections. And on other issues such as the investment cycle, we talked about a National Investment Board, then Cabinet Committee on Infrastructure. Now they're talking about a special cell. But the bottom line is that you haven't managed to make much headway in terms of pushing the investment cycle. So that certainly is a cause for concern. I think the only good news has been that at least the WPI has started to cool off. So that's something that the RBI should look at positively. More importantly, manufacturer pricing power has eroded dramatically, and that's visible when you look at core manufactured goods inflation. But yes, there is a big gap between WPI and CPI, which means that RBI can't really take its foot off the brake in a dramatic hurry. That's something they've been hinting to. So I think there have been some improvements over the last 12 months, some for the better, but nowhere at a level where one can really talk about a significant growth recovery in the economy. Some of the indicators are still very mixed, and therefore any recovery at best is modest, and frankly we're just stuck at something like a 5% growth rate for the next 12 months. I can't really see signs of an acceleration.
Stay on, Vetri. We'll talk about all of this and more. Markets are also stuck this morning around 5,800, probably waiting for the event to get out of the way. It's not a decisive move. Jet Airways, though, is a big disappointment because of the stalling of that deal, so stock remains down nearly 10% at 425. The rest is small reactions to individual things like the Mahindra Group, etc. Not a whole lot happening in trade today, but we'll be back.
We'd like you to meet the new Godrej Air Car Fragrance. It's a magical device. You may think it will make your car look bigger, but it can't. What's magical is the fragrance it spreads with just a click. Godrej Air Home and Car Fragrances.
And here's the new Air Musk After Smoke. That's until you quit smoking.
Parshvanath, House of Happiness Scheme. Pay only 25% on booking and the rest on possession. Parshvanath, committed to build a better world.
CFA Institute, shaping a financial industry that better serves society.
मेरा टाइम तो अब भी चल रहा है।
उफ, तुम रोज और यंग होती हो।
मैं तो दादी से सीखी हूँ।
PC Jeweler, jeweler for generations.
Growth is at a 10-year low, but the rupee is declining and consumer inflation stays stubborn. Can the RBI governor give growth a helping hand, or will he stick to his warning?
The Reserve Bank's assessment of the growth inflation dynamic yields little space for further monetary easing.
RB Sanjeev Goenka Group presents the RBI credit policy only on CNBC TV 18.
Presented by RP Sanjeev Goenka Group, Growing Legacies.
proven on global test tracks. Manufactured in 3 continents. Available in 118 countries. Apollo tires with U-First technology. Crafted for the safety of your loved ones.
It's not a special day in trade, let's put it like that. So 5800 is holding for the Nifty, market breadth split down the middle. The Bank Nifty hasn't lost too much ground, but that is trading in the red this morning. So that's important to take on board ahead of the policy announcement come 11 o'clock. And the other thing to watch is the rupee. Since it's opened up this morning, it's been steadily depreciating. At last count at about 57.81. So things have not panned out very well for the rupee this morning. As you can see, it's already lost about 0.5%, 30 paise or so since trade opened up this morning. But here's how small caps have done so far. Rima.
Good morning, Mitali. Talwarkar Fitness has started off strong with a gain of about 6.5%, pretty strong volumes as well. Now they've entered into a master franchise agreement for opening additional hi-fi gyms at 30 locations. Now these hi-fi gyms are a small format gym which they will be opening in tier 3 as well as tier 4 cities. So looking at opening in 30 locations. Mahindra Eugene has started off very strong and expected lines, good volumes as well. Cinemax India, over there the board has approved a swap ratio of 7 shares of face value 5 of Cinemax India for every 4 equity shares of face value 10 of PVR Limited. Gati has seen some strong price as well as volume action. A few infrastructure names like a Unity, RPP Infra, Simplex Infrastructure, they've started trade with gains of about 1 to 2%. Anjaneya Life Care had a downtick of close to about 2%. There is a board meeting today where they will be resetting the conversion price of FCCBs. And Global Spirits is quiet, but there is a board meeting on the 20th of this month where they will be forming a subsidiary by investing and acquiring majority equity share in Globus Choice Ferris India Limited. With that, it's back to you.
Thanks, Rima, for that. Nifty too is very subdued this morning, quiet actually at 5,800. Vetri, given your view on the general economy, do you think the market is also stuck in a rut for the next 2-3 quarters? Or do you see any substantial upside from here before in the second half of this calendar?
I think, we've been in some sort of a consolidation phase for the economy and for the markets for pretty much the last year or two, and I see that phase sort of continuing because I think Indian corporates are now going through a significant delevering phase, and that's the other part of the equation, that as much as the government can try to clean up policy, it's a little bit hard to expect a investment cycle-led recovery because corporate India is not in the best of health. If you think of the stalwarts who drove the investment cycle, none of them have balance sheets to really go out there and invest aggressively, and the banks are not really in a mood to go out and support it anymore because they're bleeding on a different set of issues relating to non-performing loans. So I think in a sense we are in a little bit of a slow growth rut. The only good thing to be said is that valuations are sort of in the comfort zone. They're about 5-6% cheaper than average. Earnings have grown over the last 2 years just about at single-digit ranges of about 8-9% for 2 years in a row, and therefore as a result of the market really having gone nowhere over almost 3 years, you've actually derated the market a bit. I think we're still sort of likely to stay in this kind of a rut in the near future, simply because I can't see a significant growth recovery coming through at this point of time. And I really think if you start to think about this market going higher, from here the baton has passed from PE multiples to earnings growth. So I think really for the market to move higher from here, we need to get greater confidence on earnings growth, and at this point of time I know the consensus is at about 12.5-13% earnings growth for FY14, but I think that is a bit of a tall ask at this point of time if you don't have a recovery in investment cycle. You've got an election coming up. If anything, things might actually get a little bit more choppy going into that election. So, we would still stay a little bit conservative in terms of what the markets might do over the next 12 to 18 months and when the investment cycle actually plays out. But I think from a long-term point of view, valuations being slightly lower than average, it's not a bad time for investors to continue dipping into the market, but do it gradually because it's not going to run away. There's going to be volatility, not as much as we saw pre-2010. Volatility has actually been much much lower in the last 2 years. But just keep using this trading range in the market to gradually sort of increase your allocations, and we need to be patient and wait for a full-blown economic recovery to play out, which at this point of time could be 12 months away, it could be 18 months away. I'm hopeful that once you get a new government at some point of time, in whichever form and dispensation, every government enjoys a little bit of a honeymoon in its first sort of 6 months to 1 year, and we've seen a lot of state governments in the past take a lot of the tough decisions that needed to be taken in the early part of the government. So I think we can hope that something similar might actually play out with that new government in whatever form and shape it actually comes out. But yes, I would keep my expectations sort of cautious and look at this market more stock specific rather than get too obsessed with the macro.
I was going to come to that because you really are sure that post the election results, this investment cycle will begin to pick up, because some scenarios which can come up may not be very conducive to a full-blown economic cycle recovery. Do you think companies will watch the result closely before they find confidence in going ahead, or regardless, they just want the event to be out of the way before they can go ahead with resuming investments?
You certainly can't be sure about the government and exactly what the policies will be of that new government when it is formed. But I'm just saying that historically what we've seen is that governments of whichever dispensation they have been in the past have managed to take the hard decisions early on in their tenure. So I think that's something that I would still hope for, that you will get some of the tough love that's required in terms of economic decisions in the early part of any government, and people will have a little bit more confidence at that time rather than going into the election where the attention of the cabinet and the political parties is more attuned towards elections rather than governance. So I would still hope that post-election we will be in a better situation as compared to where we are today in the run-up to the election. But on the investment cycle itself, again I'll make that point, don't expect anything dramatic to happen. This is not just about getting new investments going. It's equally about having a government which has the ability to take the tough decision to get a lot of the stalled projects which are stuck on the ground moving again. And I think what's really required is something like a BIFR which is fully empowered with government, with financial institutions to be able to take some of the tough decisions that may be required at a project level to get some of these projects moving again. Corporate India has got too much money stuck in projects which are stalled at various levels. And therefore, rather than look at this in terms of new projects and new investments, if we can just get cash flows moving again for corporate India in these stalled projects, I think that will start to address a lot of the issues in the system in terms of money that's lying blocked and an economic cycle and an investment cycle that's refusing to gather steam. So I think it can be done. It obviously requires a lot of delicate attention. It requires a lot of focus in terms of addressing some of these bottlenecks. But, I don't think we're in that bad a situation that we can't get the policymakers to deliver when it's required.
But from an equity point of view, what would you prime yourself for, Vetri? Some kind of brief but powerful surge on the market, such as the one we saw the last time the UPA came to power, and a double circuit kind of thing? Because the problem also with the market over the last few years is the narrowness of it. Nothing has moved in the broader market.
Yeah, I mean, let's look at it more from the portfolio perspective. I think from the portfolio's perspective, the challenge that we are facing is that, I talked about valuations being at average, but that's only, the statistics of it. The market is maybe 4 or 5% cheaper than average, but there's a huge dichotomy in the market in terms of valuations. If you actually look at what I would call, sort of growth companies, and these are not necessarily in non-cyclical businesses, some of them are in cyclical businesses as well, these have actually seen significant re-rating of PE multiples to the higher side over the last 3 years almost, whereas if you look at some of the other companies, and that set typically is more in cyclical businesses, these have actually seen a huge PE derating over the last 3-4 years. So there's a huge dichotomy in the market in terms of how, loosely speaking, growth companies have behaved relative to value. And I think one of the challenges in managing portfolios at this point of time is balancing between these two risks. Certainly there are some companies where earnings prospects in the near term are still muted, but this is where valuations have now started to turn attractive, and if you really want to take a longer term view, this is where you should be deploying money. But you've got to balance it with the risk in the short term that some of these companies might not see performance because the market is obsessed with earnings visibility. On the other hand, you've got some companies with fantastic earnings visibility, or at least good earnings visibility in the near term, but they are trading at very, very rich valuations. And therefore, when you ask yourself the question that even if these companies deliver on earnings over the next 4 or 5 years, can you really hope to make significant returns from them? There is a little bit of a question mark over there. So managing, portfolios at this point of time is a big challenge, because you need to balance between these two risks. The risks of buying overpriced companies, which may be great companies, but there's a risk that your returns going forward may be subpar. And on the other hand, you've got another set of companies where valuations are attractive, but you've got to deal with the fact that the market doesn't like them right now because of poor earnings visibility. Though in the medium to long term, this might be the area where you end up making the most money, because at some point you'll get the benefit of both earnings growth and a PE multiple re-rating. So that's the challenge as a portfolio manager, trying to find the ideal balance between these two. I'm not saying we know exactly how to do it, but we continuously try and balance that, and I think so far that's played out reasonably well for us.
Okay, Vetri, we'll leave it there. Good speaking with you as always. Thanks for joining in with your thoughts today. That's one view on the market, which has actually lost some steam. So sub 5,800 for the Nifty. The market breadth has slipped in favor of the declines, and the mid-cap index has actually come off quite a bit from where we opened up. Let's see how we go into the 11 a.m. event. Here's some trading ideas from Sudarshan Sakhani. We'll come back and get talking to the corporates. Of course, focus on the macros too today.
Ambuja is in a trading range after a sharp dip. That trading range could easily break on the upside. Cement in any case is not a very volatile sector. So we have these dips, and then eventually these dips find support and are bought into. Union Bank fell from 255 to 208. It's got multiple support at 208. It's been falling in that 208, 209 zone repeatedly for the last 4-5 months. Thus holding as far as possible. Siemens is it's a terrible chart. All the things that can go wrong with it have gone wrong. And we have been bearish on this stock when it cracked from 900 downwards. Now, after a small relief rally, it's given us a bearish head and shoulder, a bearish triangle, everything. Just when you start thinking it's coming down, it gives those sharp, severe pullbacks on the upside. But now that 1,990 levels have cracked. This time it seems decisively. If that is so, then Jubilant is going to go all the way to 900. Godrej has a strong support level at 285, 290. In fact, this is the level at which it stopped when the Nifty fell to 5,500. So even at 5,500, this support level was holding. It's holding as of now, and it's standing there at 290. Lupin had this sharp rally, and then it's been a trading range for almost a month. We've assumed that this trading range is breaking out on the upside. We had a buy, but it did not break out. It didn't go down either, it just stood still. At some point or the other, Lupin will break out.